What is good, fellow investors? Today we are going to take a closer look at a quality dividend growth company, Home Depot, which currently is trading at $284 per share. Home Depot is a quality company and the world's largest retailer for home improvement shopping. The company has an excellent track record of revenue growth and value accumulation. Home Depot will see some pain from a slower housing market. This is to be expected, yet earnings might hold up quite well as they remain resilient. And year to date, they are down a bit over 30%. Within the last month, they did rally as other stocks in the market, but it lost kind of the momentum coming into the end of October and the start of November. With that said, let's take a closer look at Home Depot, where we'll first look at some of the fundamentals of the company and then use our 5 valuation models. So Home Depot is trading at around 17 PE non-GAAP forward ratio, which compares to the 5-year average is 20% below at 21.5. Coming down here to the price to book isn't calculated, most likely because the book value probably is negative right now. If we jump into the dividend stats, you can see here it has a forward dividend yield of 2.7%, payout ratio of around 45%, and look at this, so nice to see. Dividend growth rate, 5-year growth rate of almost 17%, and the growth rate of 12 years. Taking a closer look at some of the financials, you can see that the revenue has been growing from $100 billion in 2018 to $150 billion in January 2022, and obviously it took quite a big jump up during COVID as a lot of other stocks, simply because people had time to go home and renovate. The net income has also followed, around $8 billion in January 18, up to $16 billion in January 22, so doubled in 5 years. Going into the cash flow statement, we want to come down here to cash from operations and the capital expenditure to see how much free cash flow they are generating. And if we look at the capital expenditures, 1.9 billion, 2.4, 2.6, 2.4, 2.5, and jumping up to 2.9 in the last 12 months. So quite steady, I would say. And if we look at the cash from operations, 12 billion, 13 billion, 13 billion, 18 billion during COVID, 16.5, and down to 13.8 with all the recent macroeconomic environment. That is to be expected, but I still think it's pretty good to see they are generating a pretty huge and a pretty substantial amount of free cash flow, I would say. The last one, the balance sheet, where we can see the total cash and short-term investments is only 1.2 in the last report, and that is not so nice, because if we jump down here in the bottom, you can see the total debt is $47.9 billion, meaning a net debt of 46.6. That is something you need to look into, how this debt is structured, because it can be a problem. But again, if it's long-term low rate, then it's not a problem. Then it's just a matter of time before they can free up a lot of cash to actually repay this. One thing I do want to note is in the balance sheet, you can see the inventory, and you can see that it's actually been growing a lot over the years to 26 billion right now. And that is a major problem, because that will hurt margins at some point, because they need to clear out inventory, they need to lower their prices, and that will obviously hurt the revenue and the margins. And one final thing to see here is the total shares outstanding on filing date has decreased 1.15, 1.1, 1.07, 1.07, 1.03, and 1.02. So they are actively buying back shares of the company, which is great to see. That was how some of the numbers behind look, but let's take a closer look at the intrinsic value to get an idea whether or not the stock is over or undervalued. And it's important not to skip ahead in this part, as I will share the assumptions I'm making for my valuation. So if we jump into the first model, we have the Graham's revised valuation model. We punch in the ticker HD for Home Depot, and it gives us all this. I expect a growth rate at around the same as the Yahoo analyst, because I think after this is going over, which probably will be in the short term couple of years, then I think HD will grow massively again. So I think this is pretty okay. We also obviously compared with the current yield of the AAA corporate bonds to give it something to hold up against. Jumping into the next one, we do have the discounted cash flow model. And if we look down here, they have pretty steadily kept around 7% growth, sometimes a bit over, sometimes a bit under. And then obviously in COVID, we had a huge amount of free cash flow suddenly, and then it dropped, which is to be expected, but I think they can get back in the long term to the 7% growth. So that is the applied growth rate I have chosen. So what we're doing here is we take the free cash flow from the different years, we then apply our growth rate, extrapolating it into the future to get some future free cash flows. We then discount that back using our discount rate of 9% to the present value, add all them together with the cash and the total debt, and that gives us an equity value. Divide that on the shares outstanding, and then we get a fair value, which in this case is $272. The next one is the dividend discount model, where we take the dividend payout from the couple of years from before now and the current year, of course, and then we do add a growth rate into the future and then get an intrinsic value based on that. And in this case, I've gone very conservative and only applied a growth rate of 6%, even though the average growth rate is around 17%, as also mentioned earlier. With the weighted average cost of capital of around 8.5, I get an intrinsic value of $322. Jumping into the next model, we do have the multiples valuation, where we compare HD to some of its peers in the market. Then we get an average PE multiple. Using the EPS, we can then get a stock price, which in this case is $265. The last one we have is the free cash flow valuation, where we have the price to free cash flow ratio. We do have the price to operating cash flow ratio average, and then we can thus use the free cash flow per share to get an intrinsic value, and in this case it's $246. Before we get into the summary, if you have come so far, thank you so much for watching this video, and please like the video and subscribe to support the channel. Let's get into the summary, and as you can see here, we do have the 5 different models summed up. The average intrinsic value is $292, which gives, at the current price of $284, an average current discount of around 2.7%. In this case, I have not applied a margin of safety, but it is a pretty good company, so even if we just go with 10%, it is still a little expensive. But as Warren Buffett said, he'd rather buy a wonderful company at a fair price. And if you think the same, then HD is definitely a very wonderful company. And I think the current price is not too expensive, but I would prefer personally to have just maybe 10% margin of safety before I would buy. Let me know down in the comments if this is a company you are interested in, and if not, I'd love to hear as well. Thanks once again for watching.